Welcome to The Explainer. Today, we're diving straight into the extreme divergences defining the 2026 economy. We are going to funnel all the way down from the massive tectonic global forces shaping our markets right now, straight to the boots on the ground reality of everyday consumers and retail investors. Because whether you're sweating over the Federal Reserve or just noticing what's selling out at your local grocery store, everything is connected. And right now, the gaps between the winners and losers are getting wider than ever. All right, let's just take a second and wrap our heads around this staggering figure. $300 trillion. That is the combined weight of public and private global equities today. We're starting right here because this number perfectly sets the stakes for our current economic reality. As market expert Sam Carson points out, our market has simply become too big to fail. The sheer size of this collateral basically dictates almost every single policy decision being made at the highest levels of government. So here is our roadmap for today. We'll be covering markets too big to fail, the Fed's play action, the AI capital wars, observational investing in action, and finally, the K-shaped reality. Let's get right into it. Section 1. Markets too big to fail. We're starting with the big picture from Sam Carson. He makes a fascinating case for why the government is now, without a doubt, the ultimate dominant player at the poker table. For decades, investors only focused on macro data and market flows. But today, you absolutely have to understand government incentives. Just think about the sheer scale of our financialized world right now. Total quantitative easing during COVID, which, remember, was historic at the time, was less than $10 trillion. Compare that to a simple 20% market rally, which creates $50 trillion in new collateral in just 2 months. It literally dwarfs a decade's worth of historic fiscal spending. If the market were to suddenly drop by 20%, the catastrophic loss of collateral would instantly trigger a systemic crisis. Because a crash of that magnitude is mathematically unlivable, Carson argues that the government is essentially forced to lean hard into the US dollar's exorbitant privilege. To manage our totally unsustainable national debt, capital is being aggressively funneled into strategic equities. The administration is basically picking winners and losers through the free market to support equities, compete on a global stage, and, most importantly, prevent a total collapse. All right, Section 2, the Fed's play action. Moving down from government strategy over to monetary policy, we really need to understand how the Federal Reserve, under Kevin Warsh, is maneuvering the bond market. They're trying to manage this massive debt load without completely breaking the system. Macro analyst Darius Dale uses a brilliant football metaphor for this, the play-action pass. Right now, the Fed essentially has to fake a hawkish stance. They have to pretend they're fiercely fighting inflation. Why? Well, they have to trick the bond market into trusting them. If they can regain their inflation-fighting credibility right now, they can safely ease policy and run the economy hot later on without triggering a massive bond market revolt. And they absolutely have to play this game because, let's be honest, the actual data is running incredibly hot. Nominal GDP is surging at 7.9% quarter over quarter. Inflation is stubbornly sticky, which is forcing long bond yields up. And crucially, R-star, the neutral rate of interest, is rising exactly when the U.S. Treasury is scrambling to roll over $12 trillion in debt. The bottom line here, capital is growing incredibly scarce and expensive, and the entire system is in an absolute dogfight for funding. Which brings us to Section 3, the AI capital wars. This systemic scarcity of capital perfectly transitions us into the intense battleground of big tech infrastructure. Big tech companies are currently draining massive amounts of this scarce capital to fund their own explosive growth. We are seeing numbers being deployed that completely defy historical context. Amazon alone is spending over $200 billion in AI capital expenditures. Microsoft is adjusting their capex to $175 billion. But the really wild stat is Amazon's AWS generating a $169 billion annualized run rate. Amazon is aggressively betting the entire company on AI infrastructure, and the whole market is holding its breath to see if these massive bets will actually pay off. And this is creating a massive divergence in tech fortunes. On one hand, you've got Amazon's AWS basically printing money with surging margins, fully riding the AI wave. On the other hand, look at a company like Apple. They're somewhat insulated from the AI infrastructure race, but they're getting absolutely hammered by the physical bottlenecks of it. Apple is facing what their own CEO called a 100-year flood in memory chip inflation. It's forcing them to reluctantly raise consumer prices just to cover skyrocketing supply costs. But, investor patience for all this spending is definitely not infinite. Just look at SpaceX. Since their highly anticipated IPO, shares have plunged 50%. That wiped out a staggering $1.3 trillion in market value in just a matter of weeks. It's a brutal reminder that in an environment where capital is scarce, the market's tolerance for unmitigated spending and sky-high valuations has a very hard limit.
Let's move on to Section 4, Observational Investing in Action.
So with the government manipulating markets, the Fed playing football with the bond market, and tech giants burning billions of dollars, how on earth does a regular person actually invest? Well, investor Chris Camillo turned $20,000 into $80 million over 17 years by completely ignoring technicals, ignoring fundamentals, and executing this exact three-step process. He calls it observational investing. First, you detect a change in culture or consumer behavior early. Second, you connect that dot to a specific publicly traded company. And third, you exit the trade the exact moment the financial press and mainstream analysts finally catch on. His massive edge comes from simply paying attention to the real world. It's a kind of social arbitrage where he spots trends way before Wall Street's algorithms do. For example, he noticed kids going absolutely crazy for a squishy toy called Neato, and he tracked down the tiny holding company that owned it, or watching a TikTok video of the Wizard of Oz at the Vegas Sphere go viral, which signaled to him that the venue had finally found its product market fit. He's betting on real-world human behavior before it ever shows up in a quarterly earnings report. But here is the crazy part. Right now, despite making his fortune on squishy toys and cultural fads, his absolute highest conviction trade is actually a mega-cap giant. Roughly 70% of his entire portfolio is aggressively concentrated in Amazon, split between equity and options. So why Amazon? Well, Camilla believes we are entering an era where intelligence becomes infinite and essentially free. And when that happens, the biggest winner is going to be the company that can connect that infinite intelligence to the physical world. With Amazon's unmatched logistical architecture and its massive foundational investments in AI chips and data centers, he expects them to yield just unprecedented productivity gains over the next decade. And finally, Section 5, the K-shaped reality. Let's see how all of this builds into the everyday economy. How does macro tension, high-level policy, and targeted tech growth actually hit everyday people? The reality is we are living in a deeply divided K-shaped economy. Data from companies like Procter & Gamble and the Atlanta Fed paints a very clear picture. The top quintile is seeing solid 2% wage growth. They are unconstrained, they're shopping in bulk, and they're buying premium innovation. Meanwhile, the bottom quartile is seeing wage growth stall out at just 0.9%. They are managing paycheck to paycheck, carefully evaluating every promotion, and facing record defaults on auto loans and credit cards. We are literally looking at two entirely different economic realities existing at the exact same time. But interestingly enough, Camillo actually warns against blindly striving for the absolute top of that K-shape. He says it comes with its own unique misery. The hidden costs of extreme wealth are severe. It often leads to deep social disconnection, a total inability to relate to the daily struggles of your peers, and it frequently forces transactional power dynamics onto what used to be authentic friendships. Because a bigger bank account simply doesn't scale linearly with happiness. Hitting a financial sweet spot absolutely brings incredible life-changing freedom, but passing into extreme stratospheric wealth, that strips away your excuses. It isolates you from reality, and it can sever the basic human connections that actually make life fulfilling in the first place. Which leaves us with the ultimate question. We live in a system dominated by astronomical government debt, relentless tech spending, and an economy sharply dividing our everyday reality. So where is your edge? Whether you choose to ride the massive tidal wave of big tech AI infrastructure, or you choose to simply observe the cultural shifts happening right on the shelves of your local stores, the opportunities are absolutely there. You just have to be paying attention. Thanks for joining me for this explainer, and I'll catch you next time.